Welcome to Brick by Brick, Building Wealth Through Homeownership. I am Kim Von Dohren, your realtor.
And I'm your banker, Ed Marko.
So, just to kind of touch on something that's happening right now in the news and is very important in relationship to the housing market, as well as what you do in lending, what I do as a real estate agent, are interest rates. And I literally just had an email this morning that said that mortgage rates went up. However, I also know that the Fed reduced interest rates 0.25% just a couple weeks ago. So that seems counterintuitive. So I am aware that buyers and sellers fail to understand that even though the Federal Reserve has reduced interest rates by 0.25%, the opposite happened to mortgage rates. They actually went up. Can you tell us why?
I can. And don't feel bad if you don't understand why that doesn't work, because there are a remarkable amount of branch managers even, or bankers, that don't understand the correlation between the Federal Reserve and mortgage rates. And the reason for that is because it's very convoluted. They actually are not directly related. The Fed rate, the rate that they talk about in the news all the time, is the amount of interest that the Fed charges a bank to use money overnight. It's the overnight rate. That is not tied to mortgage interest rates. Mortgage interest rates are tied to the bond market. So if the bond market is somewhere around, say, 4%, your mortgage interest rate is probably going to be about 2% above that, or around 6%. The bond market pays attention to what the federal rate is, but it's not directly tied to it. The bond market is a place where people put money when they're nervous.
Okay.
So when the interest rate is changed by the Fed, or we have regularly, or we have what's called a talkative Fed, they're in the news all the time. Every month they're saying something else and doing things. This upsets the market. It makes the market nervous. So people, rather than investing in other things, throw their money into the bond market. That sends bond yields up, which causes mortgage rates to go up. So it's tied to the federal rate, but it's not directly tied to it.
So what is directly tied to it? So what would I see?
The market. So let's do, I don't want to turn this into a history lesson. I could talk about this for literally hours, maybe days, about how the Fed works. It's really a three-headed monster. And some people call it the Jekyll, the beast from Jekyll Island, and that's something you can Google for fun. And they think it's evil. The reality of it is we have had a relatively stable economy, even though we had one depression and another massive recession over the last 100 years. In the grand scheme of things, even those two terrible events were relatively calm because of the Fed. Before the Fed, banks would fail all the time. This is historic. You can look it up. Having said all of that, the Fed sets that overnight rate. The overnight rate is set at, say, 4%, and they leave it at that. The day they set that, they change that from whatever percent it was up or down to 4%. There's upset in the market. And mortgage rates will go up because people, when they get upset, not just people, but institutions, they shuffle money right away into the bond market. The more people move into the bond market, the higher the interest rates, or the higher they become, the more valuable they become, the higher the rate of return is. That is where we get money for mortgages. So that raises the interest rate on the mortgage. And there's usually about a 2-point difference between the two. So
wait, before you go on, just for clarification.
Yeah.
So what you're saying is that because you use the term market.
Yeah.
So when you say market, who are you referring to, or what are you referring to? What's the market?
The market is the people. In our case, when we're talking about the market, we're talking about the people that buy and sell homes.
Okay.
Okay.
So what you're saying, though, when you refer to the market buying Treasury bills, T-bills, right? That market is just people in general who would possibly be buying Treasury bills. Right. Now, I myself generally do not go out and invest in Treasury bills. So maybe my investment banker would be doing that on my behalf.
Right. So this is a whole other conversation. But if you're involved with a 401k, any kind of a mutual fund or an ETF fund or all the other kind of, there's like 4 or 5 different kind of funds that are out there. Some of those funds are also in the bond market for stability. You want to spread out the risk. So the bond market, although it fluctuates, it's relatively stable compared to the rest of the market.
Okay. And
So,
a Treasury bond
mhm.
is like, most consumers are familiar with a savings bond.
Right.
So how is it different, or how is it the same as a savings bond?
Savings bonds can come from anywhere. You could buy a savings bond from your local municipality if they're in the bond market. You're just buying a little piece of debt that belongs to a larger entity. When you buy a savings bond, you're probably buying it from your bank. When you buy a federal bond, a Treasury bond, you're buying it from the United States Treasury.
Okay.
And the Treasury, again, that's a part of the Fed. That Treasury is also part of the Fed, and they sling. It's really complicated, and I don't want to turn this into 2 hours, but they will offset interest rates by buying Treasury notes to try and bring them down.
Okay.
When they want to raise them, they'll sell them all. Or the other way around. I forget exactly how it works because it is weird and complicated.
Economics.
Yeah,
It's economics 101.
Economics are so complicated, though. If you're going to talk about a specific part of it, you should really have notice so that you can have all that stuff in front of you.
It is.
Yeah.
Yes.
So,
but basically, without having to know all the details, the Federal Reserve manages the economy through multiple levers.
well, only 2.
Okay.
So they're supposed to through only 2. They're supposed to guarantee the strength of the American dollar, and right now they're also being used to control unemployment. And they shouldn't be doing that. That's my opinion. And that in their bylaws, they shouldn't be doing that. Their only real business is to ensure the value of the American dollar, to keep the American dollar's value specifically high. Right now,
so that's their purpose.
Right.
But the way they do that is what I was referring to as levers, such as controlling interest rates, issuing Treasury bonds, buying up.
No, the Fed, the part that does that, that's why this can get really complicated because it is a 3-headed monster. Head number 1, the Fed, is only supposed to adjust interest rates to do all of this.
Okay.
They do that by buying and selling treasuries from another head of the beast. And then the last one is all about management and what they can and can't do legally, setting guidelines, administrative functions, things like that. So you've got these 3 heads, and I'm really painting with a super broad brush.
That's okay, right?
So what happens though, to get back to the answer, is why did the rates go up if the Fed lowered rates? Well, we're going to go back in history just 1 year. 1 year ago, the Fed lowered rates and interest rates went up.
Which interest rates went up?
The mortgage rates went up. They lowered the overnight rate, the Fed rate, but mortgage rates went up, and they went up about 3/4 of a point because it was I think the final one was a 1/2 of a point reduction, and that was because there was all this upset in the market, and at that point rates hit I think 7.1 or 7.2, somewhere in there. Over the course of the last year, they settled all the way down. Nothing changed at the Fed, but because what's called the dust settled and the market started to take force on the banking industry, it settled down the bond market, which allowed interest rates to slowly but surely creep down to where they were at about 6 1/8. And then a week or so ago, the Fed lowered rates again, and that threw the bond market into a tizzy. I don't know if it was so much the lowering of the rate, but the amount of time spent in the media talking about it is what upsets the market. So it went up 1/4.
So does the market get upset at, when you said there's a lot of talk, the market, so when there's what feels like uncertainty, the market tends to gravitate towards bonds because they feel more stable and less risk averse.
They're secure. That's about as secure as you can get, other than gold.
So that's the overarching idea, is that when the market is concerned or disruptive, they tend to want to choose to pick some, which makes sense.
Mhm.
You want to pick something that feels more stable and secure, so you go to Treasury bonds.
Right.
So then when you go to Treasury bonds and that demand for them
Mhm.
goes up,
Mhm.
then that affects the mortgage rates, because the mortgage rates are what are actually linked to Treasury bonds.
To the yield, yeah.
To the yield.
Yeah.
And so if Treasury bond rates go up, mortgage rates also go up?
Yeah, usually, yes, usually.
Okay.
Almost always.
I know I am speaking in generalizations,
Yeah.
and I know that there are no guarantees.
Right.
Something different could happen, but I'm just trying to give folks, consumers who don't understand that the Fed reduced the interest rate. So if you're going to sell your house, if your house is on the market and you see that the Fed has reduced the interest rate by 0.25%, that does not help you necessarily.
It should in the long run, but it's not instant. It's just not instant. You're going to have that initial upset. Rates are most likely going to go up, and in my very many years of experience with this, they always go up when there's a change, briefly, and then depending on what was said when it happened and the other surrounding data determines how quickly after that how quickly the dust settles and rates start to creep their way back down.
Gotcha.
So they're talking about at least one more, possibly two more times that they would lower interest rates before the end of the year. I suspect that if they actually do lower interest rates 2 times before the end of the year, we will see a very quick settling of the dust because they're doing what they said they were going to do. And if they just do it quietly, oh yeah, everything's great, so we're lowering rates a little bit, and walk away from the microphone, you might not see any interest rate go up. It might stay flat for a few days and then go down an equal or greater amount. However, if they come out and they talk for an hour and they say, because of that, we're not going to lower interest rates, even though they didn't change rates, you can almost bet rates will go up the following day by an eighth or a quarter or even a half. So you need to really pay less attention to what the Federal Reserve is doing and more as to how that is affecting the bond market.
Okay.
And Treasury yields, which is the same thing.
Okay. So right now, we had the Fed do a reduction of 0.25%.
Mm-hmm.
And do we know what date that happened? Do we recall?
It was last week.
Last week.
Yeah.
Okay. So this week, or today, was it today? When did the mortgage rates go up?
Almost the following day. It was either the following day or the day after that. They went up about an eighth. But now they are stable. It's been about a week and they're stable. And I suspect, I don't have a crystal ball.
Right.
I just have way more experience than I care to admit to in lending. And I suspect in the coming weeks, they're going to come down probably an eighth or so. I'm not recommending to anybody to lock their interest rates right now because I believe they're going to come down. If you're a gambler, you take that bet. If you're not, you lock because the rates are relatively stable. Even through this, rates have been relatively stable the last 6 months or so.
Okay. So. Today is September 30th, 2025. We're going to date this podcast.
Right.
So you can tell us what are the interest rates on a 30-year fixed.
So for my lending institution today, my 30-year fixed rate is 6.375.
Okay.
Which is historically below, it's still 30 years, over 30 years of data, 8% is the average. So we're still almost 2 points below historic averages, not historic highs, historic averages.
Right.
So, people, I hate to use this kind of terminology, but we are in the new norm. I think if anybody wanted me to make a prediction, I would say that if things continue on the way that they're going, we're going to see rates somewhere between 5.5 and 6.5 for the foreseeable future. This
is how we ended up on a podcast together, remember?
That's true. Yeah. In a restaurant. Yeah.
We had a conversation about all the lenders out there that say to all the buyers out there, oh, you can refinance when the interest rates go back down to 3%. And you and I said,
yeah,
We don't foresee that happening.
No, I think if you've got a mortgage right now that's 6.5% to 7% and rates go down to 5.5%, don't wait another minute. Refinance.
Right. Yeah.
Yeah.
Because we're still at really reasonable rates in the sixes. And if you get something in the fives, hooray. But to expect to see twos or threes or fours, I just don't anticipate that unless there's a crisis.
Yeah, I hope that there's no crisis. I think it would really be great if 2 or 3 years from now, we had to take this podcast out of the library because rates were back at 3. But I seriously doubt that that'll happen.
That's some crow I'd be happy to eat.
Right. Yeah, exactly. I would really like to be proven wrong on this one because that was wonderful for the short period of time that it lasted. So.
Well, that's great. I think that was really helpful. And I hope that people at least now have an understanding of why when the Fed reduces rates, mortgage rates do not automatically go down. So thank you for explaining that.
I hope it helped. I would definitely recommend to anybody that's interested, either go on YouTube. YouTube is the best way to learn about this without having to read 9 300-page really boring books. But just type into YouTube, the history of the Fed or something to that effect. And you'll get countless videos. I've watched a bunch of them over the years. They're all remarkably accurate. Some people think it's the devil. Other people will look at it just from a historic standpoint and look at a lot of the positive it's done over the years. So do that and have fun.
Yeah, and that's so funny. I'm not sure how many people will think that watching a podcast or a video about the Fed will be fun, but I'm sure there's a few of us out there.
It's a spicy story. It really is a spicy story.
It is. I bet it is. So, and also, just a reminder, if you have any questions for us, please feel free to post a question on one of the podcast sites that actually allows you to post a question, and give us a thumbs up or subscribe on those sites also that
allow it. Yeah,
that provide that opportunity. And thank you so much for listening.
Until next time, I'm Ed Marko.
And I'm Kim Von Dohren.
You have been listening to Brick by Brick. Be sure and subscribe, post questions for future episodes, or comment. This is a Super Squirrel production, Super Squirrel Studios, Stony Creek Mills, Pennsylvania.